You're listening to the One Day Advice podcast, where your hosts Nick Riley and Paul Henderson are going to take you for a ride inside the world of personal finance. Together, we're going to give you a fully transparent, behind-the-scenes look into the financial services industry, helping you to optimize your financial life along the way.
This is Paul Henderson, and I'm sitting here with Nick Riley, and today we are going to talk about something I think is a pertinent topic for all ages, really. What do you need to know about buying a house? We are going to cover at a high level some lender requirements, 4 key things that you should know when planning for that new home, and then finally how to actually save for that purchase. In future episodes, we'll cover more of the discussion around renting versus buying, a little more on the actual logistics of working with a lender, and touching on some alternatives to direct real estate investment as well. But today we really wanted to keep things at a high level for those of you who are maybe doing this for the first time or really trying to just understand at a high level what you need to know when you're going into one of the biggest purchases in your life.
And we've gone through this process before, both personally, and we've helped facilitate this process with lenders, real estate agents for our clients in the past as well. So we're going to draw on some of that experience and hopefully add some value to this process for those that are looking to maybe buy your first home, but even those that are maybe looking to buy a second home or a rental property as well.
Yeah, we can definitely draw on some experience. I think we've both seen things go incredibly smoothly and then also blow up in people's faces. So we've seen quite a lot, I think, as financial planners.
Absolutely. And just talking about the whole financial planning, overall, I mean, investments are not the only way to build wealth. We look at real estate as a great way to accumulate wealth alongside if you have a tendency to want to build businesses or whatever, real estate is a great way to build equity and build up savings towards retirement. We all need a place to live, so you shouldn't look at that main primary residence as an investment. But if it happens to make you money along the way, then that's just a great bonus.
It's a good point. We always look at this as your home is your home, and if it happens to make you money, that's great. But it's at base, it's your home. So let's go to some lender requirements, just basic rules of thumb for approaching buying a house. And if you've Googled what do I need to know about looking for a house, or what will a lender give me for money, you've probably seen some ratios. And the two we're going to talk about just briefly are the front end ratio and the back end ratio. And these are the rules only in name. I think they're guidelines, and depending on where you go, you'll see slightly different ratios. But we'll say for the front end ratio, that is referring to your monthly housing payments. They call it PITI or PT, however you want to say it. Monthly principal, interest, property taxes, and insurance. You take that number and you divide it by your monthly gross salary. So super simple. What you would pay for your housing divided by what you make gross at your job. That is the front end ratio. And most banks are looking for something at about 28% or less.
Yeah, I mean, ultimately, a lender is wanting to make sure that you have the healthy balance sheet and the healthy cash flow to be able to pay off that loan. Lenders are trying to make money. They don't want you to default on your loan. That just adds a whole lot of extra complexity. But they want to look at you as a good borrower, and that can come through borrowing history, your credit score, but also through these ratios that we're discussing.
Generally frowned upon by the bank to default on your loan. They would like to make money, not lose it. So front end ratio, you might be asking yourself, well, yeah, but I have more payments than just my housing payment. So does the bank not care about that? They do care about that. And that brings us to the back end ratio. Your target for that, or the bank's target, is generally 36%. So what is the back end ratio? Back end ratio takes your monthly PITI. I really have no idea if it's PT or PITI. So I'm going to go with PITI. Then you add your other monthly debt payments. And that can be student debt. It can be auto debt, auto loan, that type of thing. You sum those and you divide that by your gross monthly salary. Now you have your back end ratio. And so this gives the bank a little more idea of basically the amount of debt that you have out there that you're trying to service. And some interesting things is they actually look at only at debt that's extending more than, say, 10 months. So for some people, if they have a car payment that they're going to finish paying off in 11 months, maybe wait just a little bit. That might improve that ratio. So there's some little things you can plan around on for that one. But in general, front end ratio, just your housing expenses, they're looking for 28% or less. Back end ratio, all debt payments, 36% or less. That gives you're inside the box, and banks love it when you fit inside a box as a borrower.
Yeah, definitely. And so, not only, housing payments, but, looking at car payments as well, credit card payments, any sort of consistent debt payments will be included in those ratios. And it's important to note too, these are guidelines. They're not hard and fast rules either. And each lender will have their own underwriting requirements. So generally, we've found that the larger the bank or the larger the lender, the more stringent the underwriting process will be. So the more requirements they'll have, the more, I guess, conservative requirements will be in place. And that's why if you're really close to not qualifying from a cash flow or assets perspective, maybe going to a smaller regional lender who might be able to dig a little bit deeper into your situation and be more lenient on some of the underwriting requirements. And I was just going to mention too, on the income side, while talking about these, different size of the lenders and the banks and stuff, your income really matters when it comes to the debt to income ratio, because banks are going to look at your income and look at the guaranteed portion typically. So that's going to be your salary. So we work with a lot of clients who have stock compensation, signing bonuses. Maybe they make a commission, or they're in sales. They have a lot of variable pay. Some lenders won't consider variable pay as a portion of the income, which can completely throw off your debt to income ratio. So, for instance, like if you have $100,000 salary, but you are expecting to make another $50,000 in other variable pay, and they only consider $100,000 for your overall income, that's really going to reduce the amount that you can borrow and pay on a monthly basis.
Yeah, that ratio suddenly looks a lot different if you're looking at 100K of income versus 150. And anecdotally, I'm just picturing from clients I've worked with in the past, it's kind of fascinating where you go to one mortgage person or mortgage lender and they're like, oh, I can't touch this. It's not something that I can get through underwriting. You go to another one and maybe they're an independent and they've got a little more flexibility in who they go to for lenders. And they're like, oh yeah, I can do this. And I've seen situations where someone could pay cash for their house, but they saw the interest rates were so low and they're like, long term, I want this. And they now can't get a mortgage, even though they're an incredibly safe person to lend money to. There's definitely reason to it. I don't think it's always correct reason, but you can look at it and say, okay, you probably need to work with this type of mortgage broker. You need to work with maybe a less traditional or something. There's definitely, I would say, always shop around when you're looking at mortgage brokers and what you can qualify for and what they'll give you. On that, what you can qualify for note, another thing. So we've covered debt to income ratios, the what income looks like and income qualifications when you're looking at qualifying for a mortgage. There's also the issue of affordability, and in this, banks make money by lending money, and if you qualify for something, they will want to give you as much as you will take, basically, because they're like, you are a safe person. I will make money by giving you money, and then you pay me interest. So they're not looking out for your affordability for your bottom line. They, if you have no extra cash flow at the end of the month, they don't care. They're getting their payment. So we always counsel clients that you should really be choosing your housing payment not based on what you can qualify for, but really what you can afford. And that's a more complicated conversation, but super important to keep in mind, particularly in some of these, the San Francisco, the Seattle, the New York, some of these housing markets where it gets kind of crazy quickly.
Yeah, yeah, definitely. And I mean, that's where having a financial planner in your corner too helps. In, the lender might say, "Yeah, we think you can afford this size of loan." Well, they're not going to be asking the questions about your short-term goals, other expenses that you have coming up. So they're going to be looking at specifically this loan, this purchase, and that is only a small piece of the puzzle for your financial life. So if you're considering you taking a sabbatical, or you moving abroad, or you're changing careers, I wouldn't mention to a lender that you're thinking about changing careers or doing it. If you're trying to secure a loan, they want to know that you're going to be consistently being able to pay off that loan.
Only if you don't want them to give you money.
Exactly. If you don't want them to lend you money, tell them you're going to be taking time off. You're going to be taking a pay cut, and all that good stuff. But yeah, the affordability side, just because a lender says you can afford something doesn't actually mean that you can really afford it based on maybe some of your short-term goals, maybe educational savings for your kids. So it's important to look at the big picture around affordability.
The lender doesn't care if you are going on vacation this year or not. They're not looking at quality of life for you.
Definitely.
So, okay, affordability. The other one, this kind of leads right into, I think, our last of the four things to think about here. Down payments. And I think most of us have heard traditionally you put 20% down. It's what you do. And it's frustrating if you're talking to someone who's got a few years on you and you're like, yeah, but your first home was under 100,000. That 20% number is a lot smaller. Like if I'm trying to put down 100, if I'm trying to, all of a sudden we're seeing down payments that are over 100,000. So that can be a little frustrating sometimes. I will say 20% down helps you avoid having to pay insurance on, so it can lower your monthly payments. But if you're looking at, I'm going to use Seattle as an example. If you're looking at Seattle as a super hot market, you might be saying, by the time I've put away 20%, I'm now even further behind because the properties have gone up so quickly. So I think we want to acknowledge the fact that 20% is traditionally the conservative, correct approach. That has kind of been changing. And Nick, do you want to opine on that?
Yeah, I mean, I can just use the Seattle market, and just because I saw this number very recently, but the average home price in Seattle is $793,000. And that's including the surrounding Seattle area. So if you're living in Seattle proper, it's definitely going to be much more expensive than that. But even that itself, I mean, that's $140,000 for 20% down. And a lot of people in buying their first home might not have that around, but they have the income to support the loan process. So that's where the cash flow really comes into play. And 20% for the longest time has been the traditional, largely because you put less than 20% down, you might be responsible for primary mortgage insurance, or PMI, which tacks on an additional cost to that mortgage. But it really kind of depends on your cash flow situation, the amount of cash you have on hand, on whether that 20% makes sense, or putting more down to decrease the monthly payment amount. Or I've seen plenty of, and I've done it myself too, of doing like a 10-10-80 split, where you do 10% down, 80% on the mortgage, and then another 10% on a HELOC, which a HELOC is just a home equity line of credit. And that's an interest-only loan that allows you to put less down initially, but then have that flexibility to pay down that HELOC faster. Use that for home improvements, or you essentially have a line of credit that you can use towards improving your home. So there's a lot of different nuances and strategies that lenders specifically will be able to kind of walk you through. And back to Paul's point, and I'll always make sure you have a few different lenders that you're talking to, and kind of a general rule of thumb, include a larger lender in that. So they'll have a more stringent underwriting process, but you likely will get you a better rate, and then include a regional lender. And then maybe an online lender like a Better Mortgage or Rocket Mortgage. The service for an online lender isn't going to be nearly as good. So if you're really in a competitive situation for securing financing for a home, a seller, if you're looking to buy a house, so the seller is going to look at you in terms of being able to pay to get that money by closing, and working with a credible lender is going to improve your chances of winning out against other people that are trying to buy into that home. So it's a fun process. I love talking about the home buying process, but we'll definitely have a lender come on and interview them on this podcast just to give you a little bit more detail on the ins and outs of that lending process.
Yeah, I'll just throw in there as a taste. You can get an idea of how complex this can get, where we're talking about traditional conforming loans, and that's where you want to put down 20% and that type of thing. You can also get into the HELOC and piggybacking, like Nick was explaining. Then there's the Federal Housing Administration, FHA loans, and in that case, they'll finance up to 96.5% of the home values. Now you're paying 3.5% down. That one comes with mortgage insurance premiums, which is MIP. And I'm just saying this because I love the fact that FHA loans have MIP. Traditional loans have PMI. They couldn't call it the same thing. It's just another acronym.
Yeah.
I get kind of a kick out of that. But yeah, the point of this, I think, really is someone can quote you a mortgage rate and an amount, but that is not your answer. It's not the number that you will get from everybody. So shop around, look at all of your options, work with someone to see if it's your first home. Is there a first home buyer's credit that you're going to qualify for? Really do that due diligence to make sure that you're taking advantage of everything that you can, and also getting the best deal that you can on that on that interest rate.
Yeah. And I think one mistake people make is feeling like they're married to one lender. And lenders, it's a transactional process. So they're used to cranking out a lot of different loans. If there's someone specifically that you work well with, still get a quote outside, and if they're a good lender, they will recommend you getting a quote elsewhere as well, because it gives them negotiating power internally to say, in order to close this loan, they're also getting an offer at that, so-and-so bank. And, can we match that? So they're able to go to the underwriters and try to match that. So either way, it gives you negotiating power. And, as kind of top of mind, in considering lenders as well, if you work for a large employer, there may be certain banks that have specific relationships or direct relationships with that employer. So for instance, Amazon, large employer across the globe. And, there's certain lenders that have direct relationships with Amazon that will consider variable pay. So, any stock compensation, any variable comp, they'll consider that in their underwriting process. So it's important to look at certain lenders. If you're kind of on the cusp or on the borderline of being able to qualify for a certain level of home, from a lending standpoint, then definitely look around, and it's worth the extra time.
Yep. I'll just add one anecdotal story. I've definitely had the experience where I'm talking with one broker for a client and then talking to another one. And the first one will just say to me, yeah, I can't, I can get this through, but it will be incredibly high. And they want to continue working with me and my clients. And they will flat out say, I'm not going to be your best deal. And they can't necessarily tell me who will be that best deal. But if you have a good relationship, that broker should be able to tell you basically yes or no. Can I do this for you in a good way? So I feel like that's an important thing. Particularly, also, if you're working with a financial advisor, they should have that network, and something that should be something that you can tap into.
Yeah, definitely. And as we're talking through this, I'm just thinking of all the different little levers that you can pull in the home buying process. I don't know how many to mention on this podcast, but it might end up being further episodes. But I'm just
give me an
thinking,
example of like two.
Yeah. So one, I mean, if as a buyer, being able to potentially negotiate, selling costs and closing costs into the deal. So being able that will save you more money out of your pocket up front that you could just wrap into a loan. For instance, if you're looking at $1 million home, and that's the price that it's listed at, maybe you offer $1,010,000 and include 10,000 in closing costs from the seller. Well, that equates to about $1 million on your end, but you get to finance the full $1 million and 10,000 as part of that. So, and then you're not having to use out of pocket expenses for all those closing costs as well. So that saves you a little bit more money up front in having to use some of your additional cash to pay down those closing costs. So that's just a little nuance that comes into, and that's something that your real estate agent specifically will use in negotiating. The other thing is, so in considering, we touched on the debt to income ratio previously. One thing that's important for those who are looking to buy additional real estate. So if they already have an additional mortgage or an existing larger debt payment that they're responsible for on a monthly basis, it's very important to note the structure of that loan, in the sense that how, it depending on the loan, it's going to affect the size of your debt payment. So for instance, a 15-year mortgage is going to have a larger monthly payment than a 30-year mortgage. And if you lock yourself into a 15-year mortgage, you might be doing the prudent thing in paying down your loan faster, but that increased size of monthly payment is going to take up a large portion of that debt to income ratio. So you actually qualify for less of a loan potentially for that additional property. And that's something I've come into experience personally and with clients as well. But if that 30-year option reduces the monthly payment, you can always make excess payments to that on a monthly basis. But the lender's not going to consider those excess payments towards principal as part of your monthly debt obligation. They're going to look at the minimum of what you have to pay. And, that's a big factor in kind of qualifying for different sizes of loans.
Okay, now I want to do one too, but
just go for it.
I think we'll talk about savings at the end, but frankly, it's a pretty quick conversation, and it's not too groundbreaking. So I was just going to add, and I think oftentimes people don't like to talk about this because we're Americans and we're all self-made. But when you're talking about financing, I think it's worth mentioning that there's also the concept of intrafamily loans. And
great point. Yeah.
That is for people who have parents or family members who are looking at them saying, I really want to help you some way. The house purchase is often one of those key areas where they're like, hey, my parents or my family member did this for me when I was young. I now want to turn around and provide the same to the next generation. And there are some pretty good options out there. Like basically, if you're trying to move money to the next generation, an intrafamily loan is one of the best ways to do it, as far as it's not going to impact their estate tax, or is not going to impact their gift tax returns. If you're paying a minimum rate, I don't know what it is off the top of my head right now, but I want to say it's under 1.5%. And you can structure that loan in maybe it's an interest only loan. Maybe it's a 40, 50, like maybe it's a very long-term loan. You can keep that payment down low, and it gives your family member the ability to get assets out of their estate. And then they can also forgive that loan over time, and they can use the annual exclusion amount. So this is more of an estate planning tactic, I think, than a true how to buy that first house. But if you're looking at buying a house and you have family members that have offered to help in some way, keep in the back of your mind that it could be a helpful conversation for them and their plan to know that you can pay a very low interest rate and it helps both of you. So
Yeah.
there's more complications there, but I think
Yeah, I
it's
think
worth bringing up.
yeah, you bring up a great point too. And, couple things to add to the family loan or gifting side. Keep in mind a loan to a family member is from a lending perspective. If that's how it's structured, they're going to look at that as an addition to your debt to income ratio. So that's another debt payment that you would be responsible for, and that may impact ultimately your ultimate loan amount that you qualify for. So a lot of lenders will say, I mean, lenders don't specifically, like, if it's going to be a gift, they aren't going to write a letter to the IRS saying like this is amount of a gift. Like, the gift is that's what you're responsible for, or your parents or a family member is responsible for reporting. So and each lender has their own requirements around. Some will say, well, like, only 5% of the total home value can be used from gift money, and then other lenders will have much more conservative values on that. So they'll be a little bit looser on those details, where they might allow the full down payment to be in the form of a gift. So there's a lot of things to consider around the gifting side that both Paul and myself have had a lot of experience discussing with clients. So feel free to email us directly or call us with questions around that.
And I'll move on from there. You just got a slight taste of what happens when Paul and Nick go way off of the kind of original bullet point script, but you can tell we enjoy talking about this stuff. And there's just so many, let's call them planning opportunities, when you're talking about major purchases and interest rates and gifts and estates and all the stuff that we get to nerd out on occasionally. So we're over time, but I'll just, to live up to our original outline, I'll just say our savings approach we're supposed to go all the way back to that down payment. How do you put money away for that down payment? First thing, know your budget. And that's partly know where you can trim in your monthly spending to save for that down payment. And that's just your basic savings advice. Secondly, you also need to know what essentials need to stay, so you can say, okay, once I actually own this home, what is my budget going to look like? And that gives you basically the ability to say, this is what a comfortable, affordable monthly housing payment looks like. So at a high level, just start tracking your expenses, know roughly what's going out each month. And that gives you the freedom to choose to change that or not. If maybe you don't need to change a thing, but a lot of people come to us and they've never thought about what they're actually spending. So knowing your budget, and then know your timing. And again, high level, investments are wonderful. The stock market is a great thing long term. It can be less great in the short term. And when you're talking about a house purchase, usually when we're having that conversation with people, it's something that they're looking at in the next year, 2 years, something like that. And again, your situation might be slightly different, but in general, if you know that you have a large expense coming up within the next year, next 1 to 2 years, that should be close to liquid, whether it's cash like investment or something. The worst case scenario for me is that you have your dream house, you're looking at it, your offers in, and the market has a correction and your down payment just vanished. And that's a slightly extreme example, but we would like to avoid that. So
Yeah,
I'll just know what you're spending, and if it's money that's going out soon, that should be liquid and very not at risk.
Yeah, and you don't want to stretch yourself out too thin. And the home buying process, it's a great experience. And if you set a budget for yourself for say $500,000, be honest with yourself. It's probably going to creep up higher because as you're looking at houses, you're always wanting to really maximize what you can afford, and that's where having a true financial planner in your corner, being able to assess that situation for you and really find out what you can truly afford based on your other financial goals as well is very important.
And like we said, future episodes will talk more about should you even be buying? So renting versus buying. Again, the logistics of working with a lender in a little more detail with an expert, and then alternatives to direct real estate investment. So if you really want that investment in real estate, but you're not certain that owning the house is the right way to do it, we'll talk a bit about what your options are in that case.
Hi, I'm Nick Riley, the founder of One Day Advice. If you like what you've heard, we'd greatly appreciate your help in spreading the word. After all, we are financial educators, not marketers. Thanks for listening, and remember to leave us a review.
Nick Riley is the founder of One Day Advice, an independent registered investment advisor. Paul Henderson is the director of financial planning at One Day Advice. Both Nick and Paul serve as wealth advisors to their clients. All opinions expressed by Nick, Paul, and podcast guests are solely their own opinions and do not reflect the opinion of One Day Advice. This podcast is for informational purposes only and should not be relied upon as a basis for investment or financial decisions.